Hey, this is Andrew Kuhn, and you're listening to the Focus Compounding Podcast, the podcast where Geoff and I talk about actionable stock ideas, timeless investing concepts, and the overall way that we think about investing at Focus Compounding Capital Management. Go to focuscompounding.com and enter in your email to get a free watch list from Geoff every other week. And be sure to check out all of our other work where Geoff writes about stocks at focuscompounding.com. I upload how-to investing videos on YouTube, and we both manage capital for investors at Focus Compounding Capital Management. Thanks for listening, and be sure to subscribe to follow along. Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, sitting next to Geoff Gannon on the number one value investing podcast in the world, soon to be the number one YouTube channel in the world as well for value investing. How's it going, Geoff?
It's going very well, Andrew. How's it going with you?
It is going great. We hope it's going great for everybody else as well. Hey, if it's the first time that you were tuning in with us, help us get to being the actually the number one value investing YouTube channel in the world. And you could do that by hitting that subscribe button, thumbs this video up, leave us a comment. I respond to pretty much every single comment. So leave us any comment that you may have that helps hack the YouTube algorithm. We are trying to do that. If this is the first time you're also tuning in with us and you want to get access to all of our other work, the probably best place to keep up with us and what we're doing is my Twitter at Focused Compound. If you're watching on the screen, this is focuscompounding.com. Feel free to go there to get some premium access research reports on stocks by Geoff and other members. You could join the Gannon Gazette for free right here. Some people have emailed me asking if they're on the email list. You probably are. We just haven't really sent out one recently, but you could do that and you could join by entering in your email. We're wearing the same exact outfit as you can see on the latest podcast, which is kind of funny, but go to focuscompounding.com, and if you do sign up, use the podcast promo code, which is podcast, and that will take the subscription price from $60 a month down to $50 a month indefinitely, as long as you do stay a member. So one of the most interactive or most engaged episodes that we have is always something to deal with the financial statements, how to read a cash flow statement, what is free cash flow, stuff like that. So in today's podcast, we're going to be going over the balance sheet. We did how to read a cash flow statement last week, so be sure to check that video out if you have not already. But we're going to be going over the balance sheet, and for people listening on the podcast side of things, we're going to talk out loud to hopefully make it interactive for you as well. This is Chipotle's, one of my favorite QSRs. I probably eat there 4 to 5.
Favorite.
It is, yeah, it is my favorite. I eat there probably 4 to 5 times a week.
Took a road trip together. It's definitely your favorite.
Yeah, well, because it's cheap, right? $9. Yeah. I think I usually pay like 8 something if I, if I need some extra protein, I'm gonna do double meat, right? And then it's like, I don't know, $10 to $12. It's cheap. The quality's good. It's quick. I think the actual money to calorie ratio is like the best, because you can get a burrito for like 1,000 calories and it's like $8 or $9 or whatever it is, and it's good food. I love it. I don't understand why they still don't do breakfast there yet. Like, change the meat for like eggs or something, and then make like breakfast burrito. Should we start our own breakfast burrito thing? Oh my god, we just came up with an idea. No, just kidding. So Chipotle, everyone listening is familiar with it. It's great. Geoff does not like it that much. And this is their balance sheet. So let's go over it line by line, and then if we want to pull up a different one, we can.
I don't like eating there. This isn't a comment.
Yeah, he doesn't like eating there. Yeah. Okay, so obviously a balance sheet is a snapshot in time. Income statement, cash flow was over the period. So if they release it yesterday, this balance sheet is snapshot in time. And if anyone knows how to turn this interactive stuff off on the SEC.gov website, please let me know, because this is just, I complain about it and I don't like it.
Okay.
So current assets, first line, right? So what's the first thing that sticks out to you, right? You immediately, I know you, in your head, you probably look at like the total current assets and then compare that to the total liabilities,
right?
And to see if they cover, like if the total current assets can cover the liabilities and all sorts of things like that, right?
Right. And in this case, they're not going to remotely because they probably have a lot of leases. Let's see if that's true. Long-term operating lease liabilities are really big, right?
Yeah, $2.6 billion.
So that's their issue. So they basically have to cover their rent all the time. That's the really big deal that we can see here. So actually, they're using that, which is now how we account for things under GAAP. They're going to end up with very high liabilities, right? So their actual liability amount is way, way higher than total current assets. So their liquidity position is poor from that perspective. So their total current assets are like like $1 billion or something like that, and their total liabilities are like $3.4 billion, let's say. So 3.5 times more would be really bad, except those total liabilities are mostly in the form of these long-term leases, which we'll read about, and so it might be much safer. If, however, those leases were like the landlord could tell them that they have to pay all of it today, then this would be an unsafe stock, and so you wouldn't want that. So if it was, those were where the liabilities were from. But they're not. We know that they're from these long-term leases, so it's a different situation. So we're just going to be very aware of the fact that that's the big financial risk here, and it is a very big risk. If a restaurant's going to fail or something, or a retailer or something, it's going to be because of these leases.
Sure. Okay, so current assets. Right?
Okay, so current assets, they have a lot of cash and they also have a lot of investments, right?
Yep.
So they're probably going, we'll read about the investments later, but they're probably going to be a situation where they're are overcapitalized. They just have a lot of cash, right? So if we take cash and investments together, let's assume that investments are some sort of cash, equivalent.
So for people listening, cash is $480 million, and in investments it's $400 million. So call it $880 million.
Right. So it's very close to $900 million. So they also have an item called restricted cash, which we'll get. A lot of people don't like to count, but it's still basically cash usually. You'd have to read about what the restriction is and stuff, and if it matters. But you'd also throw that in, it's $900 million. So you take $900 million, that's very big. Now we can compare that to total current liabilities. So one way is just taking like the cash type things, comparing it to that. That's very good. Their total current liabilities are not high at all. So actually this company seemed at first when we looked at it to have a very bad balance sheet. It actually has a very strong solvency position for this year. The issue is, as we'll see, you see this item called operating lease assets, which is huge. And you see this other item called long-term operating lease liabilities, also huge and basically offsetting.
And so operating lease assets is $2.5 billion, and long-term operating lease liabilities is $2.6 billion.
Right. So everything about what we talk about how safe or whatever this stock is going to break down to how they can cover their rent over a long period of time. We can tell from this that it's such a small number in terms of the current liabilities, right? So if we look, their current operating lease liabilities are what here?
Current operating lease liabilities, what is that? My eyes, $173 million.
$173 million. And what's long-term operating lease liabilities?
Long-term operating lease liabilities, $2.6 billion.
Right. So let's call that, let's say 2.6. Let's just round it down to be kind to them. We'll round the other number up to 2. That's if we could put 200 million into 2.6 billion, let's say, that would be 13 times. So we'd really be asking, wait, does that mean that their average location is leased for another 13 years on average? That's very long. It's fine. I mean, supermarkets do it and stuff, but that would be incredibly long
for like a QSR.
Yeah. So it would mean that they don't own these locations and they're committed to keep them for a very long time. If something happens to the Chipotle chain where it's not popular or something, they're going to be stuck in a way that's going to almost guarantee colossal failure. So what'll happen is, as the concept works, it'll produce a lot of free cash flow, all those sorts of things. But then if it declines or something, it's just going to end with the stock going to zero. So that's the kind of thing that you have when you have these very high leases, this kind of leverage that you have. Now, in previous years, we wouldn't have seen this. You would have had to read about it in the footnotes, because if you look in 2018, they accounted for this under the previous method.
Yeah, because there's nothing there.
There's nothing there. And so their balance sheet went, if we take total liabilities and shareholders' equity together, so that's the very bottom line in a balance sheet. That will work out to be the same as total assets. It's an accounting identity thing. It's one of the first things they teach you in accounting. So you'll always notice that the total assets and the total liabilities and shareholders' equity have to equal each other if the balance sheet is balanced. So that went from 2.something billion.
2.2 billion.
2.2 billion to 5 billion. So it almost doubled. And so that basically is all the off-balance sheet commitments they made before are now being brought onto the balance sheet because of a change in the accounting of leases. So that was always the big thing with Chipotle, is that they always had this. That's what allows them to have very high returns on assets too. Of course, it changes things, because now it's going to affect their return on capital and things like that screens have, because it's going to show them going down from what they had before. So that's one of the ways we would use the balance sheet, is to figure out like how much they actually have invested in the business. So let's use that. So the actual investment in the business generally is going to be your accounts receivable, your inventory, and then your PP&E.
So the tangible where are we at here? PP&E.
So PP&E for them is basically leasehold improvements. It costs quite a bit to like turn a location over to looking the way Chipotle wants it to look, because they have a specific thing that they do. So kind of like Cheesecake Factory. So they make some significant leasehold improvements. And so that is the other big item there. So those three together, accounts receivable and inventory are pretty small, right?
Yeah, so you're like 100 million right there. Yeah.
But it's like 1.4 billion in leasehold improvements, property plant equipment. Yeah. So 1.4 billion. So the item, so we add those up together. Let's say 1.5 billion is what it was. Can we find, do you have the income statement? Yep. So let's just go to the income statement quickly. And then we see the income statement, their total operating income
from operations, 443 million.
So that would have been like they were getting a 30% or higher return just on the assets. Whereas if we go up again, we can see that there are liabilities that offset that. So the liabilities that offset, of course, are the accounts payable, the accrued payroll, which are both higher. There's also unearned revenue. I'm going to guess, we haven't seen it yet, that has something to do with gift cards, because I don't know why else a restaurant is producing that much unearned revenue. And so if we add those things together, that's even higher. So that's offsetting. So the unearned revenue is a form of float. The payroll and benefits, they're paying people slower than they're both. So if we do this, accounts receivable net and accounts payable, you'll notice that accounts payable exceeds accounts receivable. So that means basically that the combination of those two things is a source of funds for them. It's investors, owners of the stock, are not the people who are on the hook for this kind of money. They don't have to like use retained earnings from the business to finance growth. It's actually being financed from them paying their payables slower than they are collecting their receivables, basically. And then inventory, not a big item for them. And we compare that to things like accrued payroll and benefits. So you take those two together, accounts payable and accrued payroll and benefits, and combine it with accounts receivable and inventory. And we see, so we'll just do the math right now. Accounts receivable and inventory were about
100 million.
100 million.
Yeah.
And then payable and payroll and benefits together are more like 240 million, something like that.
Yeah, sure.
Yeah. So 240 million is a lot bigger than 100 million. Plus, they have other sources of float like the unearned revenue. So the only thing that they were really invested in before was the leasehold improvements. So net, the leasehold improvements are maybe $1 billion or something, right? So like you take that and you subtract everything else out. We didn't do the math here, but I'd say that probably on like a magic formula type basis, we're talking maybe they had $1 billion invested on average in 2018, 2019. Well, they earned, what did we say in operation?
440 million, right?
Right.
443 million.
Right. So we're talking about like pre-tax returns on capital of like 40% or higher.
Yeah,
right?
exceptional.
Yes. But then let's do it with the math of taking the off-balance sheet stuff onto the balance sheet. And this will really show us something about how restaurants in general work, but especially something like what Chipotle is doing. So now we have an item of 2.6 billion plus the short-term stuff of another 173 million or something. So we're up to like, that's actually close to 2.9 billion. So we're having a number that when we add that in, let's say instead of being $1 billion that they're earning it on, the capital that they're using, they're actually using closer to like 4 billion in, and then the operating income was what?
443 million.
Right. So it takes it from being a 40% pre-tax return
10.
to like 10.
Yeah.
So it shows you that the way in which Chipotle and businesses like this succeed is that someone's willing to lease them the space and earn a lower return. We know kind of by doing this math here, the way the economics work, that the landlord has to be making a lot lower return and Chipotle has to be capturing that leverage. That basically Chipotle is taking the risk that this doesn't work out well. The landlord's getting a guaranteed return, and then us as the investor in Chipotle is taking a risk on the fact of like how much we're covering rent by.
Which makes sense, by the way. If they're doing longer term leases, typically that's what happens. Do you want to go down to like the lease?
I do, but first let's go to the income statement. Okay. So the income statement is not actually part of the balance sheet, but it's helpful here if we look at occupancy. So we go to the restaurant operating costs under occupancy. What does that number say?
363 million.
And that's the part that's kind of worrying if we want to do it. So
what is that? So explain that.
So let's talk about, so occupancy is rent.
Yeah.
So they're paying $367 million in rent. If we look at, let's do, let's get a calculator and do this so we can do the math here simply so I can show you the kind of leverage we're talking about here. Okay. So we can figure out kind of the math of how this works. So their total operating income was income from operations. We'll start with that's 443 million, and then we'll add back some stuff. So 443. Just truncate the number, so don't do this stuff after the decimal. So 443 plus depreciation and amortization was 212.
Just for people watching, 212
add that
million.
back. So that's their EBITDA basically. They have pre-opening costs and impairment. Well, let's add the impairment of 23 million, so plus 23, and then we're also going to add. That's it, and then we're going to add back the occupancy. So the occupancy was 363. We said.
Yes.
Okay.
So plus 363.
Okay.
So
they're covering rent 3 times basically. So take 1041. That's EBITDA, earnings before interest, taxes, depreciation, and rent, and then divide it by 363. Right, so 2.87 times coverage. So, and then if we just reverse that, so let's go back to 1041, or actually let's do it this way. So let's take 1041 minus 363.
1041 minus 363
equals, and then divide by 1041.
Whoops. Right, so 1041.
It's going to be like 67% or something.
Minus 363.
Yeah.
Divided by
1041. 65%.
Yep.
So their margin of safety basically is that they can decline by 65%. However,
and still be able to cover.
Their EBITDA can only decline by 65%. The issue that comes up, of course, is that their food, beverage, and packaging and their labor here is their
significant. Look at.
Well, yeah, these are their prime costs for a restaurant, right? So if we add those two together and see what that math works out to, let's take 1472. Is it 1472? Yeah, 1472.
Do you want me to?
1847 plus 1472. Okay, and then we divide that number by the top number of the revenue, which is 5586. Yeah. It's a high number. That's a very high number.
So that's 59%.
Yeah, and that's a higher number. They're a quick service restaurant. They're a fast food restaurant. So it's not unusual for them to have a higher number there than a restaurant where you'd be getting like full table service and stuff. But that's a higher number because that's 60%. So, and the issue with Chipotle, of course, that I would wonder about is the economies of scale at the location level. That a drop in the revenue could cause a bigger drop in the operating income. So it may be more leverage than we realize about that. But the coverage is much better than something like we looked at Buckle or something, or GameStop, right? Yeah. So it has better coverage than that, but it's just an awareness of how much leverage they're using. So they're using a lot of leverage to take what's really, we said, EBITDA of what do we say, like $1 billion, and turning that only into like 400 some million, 500 million in operations, in income from operations. So that's where we see all that from the balance sheet. We can now look at the notes of the balance sheet.
Sure.
Yeah.
Let's go down. Cash flow statement.
Okay, let's start with restricted cash.
Okay.
All right. So
here we are. We maintain certain cash balances restricted as to withdrawal or use. Restricted cash assets are primarily insurance-related restricted trust assets.
So we understand why they have the restricted cash. I don't think it matters generally. So, I mean, restricted cash is not a big item, but generally if you had restricted cash that's only restricted like that, then, you could borrow and whatever. You would have more borrowing ability because you have the cash. So I still think that generally restricted cash should be counted as cash unless it has unusual restrictions. Cash and equivalents is the normal stuff that we would expect. The one that I care about is...
Look at that. Accounts receivable primarily consists of receivables from third-party gift card distributors.
And from landlord, tenant improvement receivables from landlords. So landlords sometimes are giving them money. Then they have vendor rebates. It gives you some idea about that. They're getting a lot of things because of their size, probably. Inventory, which is basically this, not concerning me because their key ingredients are beef, pork, chicken, beans, those sorts of things. They do mention that it's a small number of suppliers, which we know based on their business model. Chipotle is, probably relies more on a smaller number of suppliers than most companies do because they have that stuff about like trying to have more. Can you scroll up a little bit? A little bit more. So we look at investments, because they want to like control the whatever you want to call it, the food quality. Now they have safety things, but in terms of the like using GMOs and stuff like that. So they talk about investments, and they don't get into much detail.
No, they don't really have it.
They'd also have to find that later. If we scroll down some more,
even on the leases, they don't.
Yeah. So the lease details are. Lease improvements and leasehold improvements in buildings, they're depreciating over 3 to 20 years. This is the estimated useful lives. Furniture and fixtures is 4 to 7 years, and equipment is 3 to 10 years. Those are pretty normal. Okay, so they talk about the details of the leases. Why don't we read some of that? Because this would be the key thing.
What part do you want me to read?
I would say, let's see. So they have, so our leases generally have remaining terms of how many years?
Of 1 to 20 years.
Do they have an option to extend?
I said most include options to extend the leases for additional 5-year periods.
It doesn't say whether...
Our leases generally have remaining terms of 1 to 20 years, and most include options to extend the leases for additional 5-year periods. Generally, this stupid pop-up box. Generally, the lease term is the minimum of the non-cancelable period of the lease, or the lease term inclusive of reasonably certain renewal periods up to a term of 20 years.
Okay. So that doesn't give as much detail as we might like because it doesn't say how many 5-year periods they have.
I don't understand that, but that's kind of surprising me because it's such a big part, obviously, of their business that they don't break it unless we're just...
Yeah. So because what will often happen is, so like when you have you often will have a company that will say something like, let's say a supermarket or something, will say that we generally have, leases are generally 40 years. Originally, our leases generally have X amount remaining on them. They generally include 2 or 3 or 4, however many options that we can extend it. And those are just options that we have, and the landlord doesn't have an option. So let's see. Let's move down there. They go into the accounting detail, but the parts that were interesting to me is so the non-cancelable part probably means that they'd have to pay a lot. From my understanding of reading that sentence, that would mean that everything that isn't the option would have to be paid. So their obligation that they're saying that they have is the entire period. So if they signed a 20-year lease, then presumably they have to pay for 20 years if they canceled it. And then we have rent escalators. So leases typically contain rent escalations over the lease term. And then they have rent escalations that can be based on inflation indexes, fair market value adjustments, which is also, so they basically might have to pay increasing rent if the market rate of rent, basically. Yeah. So the last thing is that they put a little bit where they say that the lease agreements do not contain any material residual value guarantees or anything like that. Okay, which is good, or restrictive covenants. One thing that was interesting is the insurance thing. So we should go back there because the restricted cash is related to insurance. So that was an unusual thing to see such a big item for a company.
It says we are self-insured for a significant portion of our employee health benefit program and carry significant retentions for risk and associated liabilities with respect to workers' compensation, general liability, property and auto damage, employment practices liability, cyber liability, and directors and officers liability.
Yeah. And then reserve contingencies for litigation.
We are involved in various claims and legal actions that arise in the ordinary course of business. We record an accrual for legal contingencies when we determine that when it's probable that we'll have incurred a liability, and we can reasonably estimate the amount of the loss.
And then if we keep going down, revenue recognition, so gift cards.
Says we sell gift cards, which do not have expiration dates, and we do not deduct non-usage fees from outstanding gift card balances. Gift card balances are initially recorded as unearned revenue, which is what you said, which was like, what, 90 million, I think you said. We recognize revenue from gift cards when the gift card is redeemed by the customer. Okay,
but what was the date of the balance sheet?
It was recent, right? What was it?
There you go. Is that good enough?
Nope. Sorry. Okay. Yeah, it's 2000.
Right.
December 31st, 2019.
Yes. So here's the problem that I see. We're using the gift card balance as of December 31st. When do you think the gift card is most likely to have been given to someone and not have been redeemed yet?
December 31st, Christmas.
So that's the problem with the balance sheet that way. So you have to look at each of the quarters and stuff like that.
Give me a Chipotle gift card. That'll make me happy.
Okay.
Best gift for Andy. Put that on my stocking.
All right. So if we keep going down on the footnotes to the balance sheet, footnotes to all the accounts. We have gift cards, so we can move past that. Chipotle Rewards is the other one that I was interested in.
Says during the first quarter of 2019, we launched Chipotle Rewards nationally. Eligible customers who enroll in the program generally earn points for every dollar spent. After accumulating a certain number of points, the customer earns a reward that can be redeemed for a free entree. I got to get up on that.
So it just
says they defer revenue associated with the estimated standalone selling price of points or bonus vouchers earned by customers as each point or bonus voucher is earned.
Yeah, this one's been interesting to me. I would want to know more about the rewards thing, and you can get some from the footnotes here. It seems like a very bad rewards program.
Why do you say that?
Well, for instance, it has weird things in it, like the points generally expire if the account is inactive for a period of 6 months. So it's just interesting. I wonder how serious they are about the rewards thing, whether it's a test of things and that eventually they'll improve it. It's not competitive with, like, you know, say, what is it, Bloomin' Brands and stuff like Outback and things like that do reward programs. So they may feel that they don't need it and stuff, but I've always been interested in that, because if we read the entire thing there, so it says eligible customers enroll in the program generally earn points for every dollar spent. After accumulating a certain number of points, they earn a reward that can be redeemed for a free entree. So they also have the promotions that they talk about. They are the earned. So this is the part that's really weird to me. If we read the last sentence, right?
Yep.
Earned rewards generally expire 1 to 2 months after they are issued, and points generally expire if an account is inactive for a period of 6 months.
Yeah, that's weird.
So they must obviously be wanting to have very regular business and not caring about anything that's longer term like that. But it just seems like an unnecessary way to annoy potential customers or people who are your customers by having things expire. I don't know if you actually go there and try to redeem and stuff, they'll let you redeem it.
Yeah.
You know what I mean? But that is a sort of weird thing for a customer service thing to be that restrictive. So I've always wondered about that. So let's see. So they have this adjustments is very complicated
for the lease.
Yeah. So this has to do with an accounting change that was made. If we scroll down from here, let's see if we have any. So here we go. So supplemental balance sheet information. So this stuff is things that technically, I guess you could say, isn't the balance sheet, but you have to read this to understand the balance sheet. So this gives us detailed of what leasehold improvements break down into. As you can see, if you didn't, this is all stuff that, like, it's good that we're doing Chipotle because some people might have visuals of an idea of it.
Yeah.
But this can tell you these things don't stand alone. They don't own the land underneath them at all. They have very high leasehold improvements in buildings. So these are things, if you didn't know, you'd be like, oh, wait, are they in malls? What are they in there?
Yeah.
And something like that. Obviously, something's going on there. And then they have things like the accumulated depreciation, which is always an important one to look at. Here, the stocks trade so far above, like, book value and things like that, that stuff doesn't matter. But obviously something with a ton of accumulated depreciation is interesting because they may have over depreciated over time. Yeah. If we go down to revenue recognition, they talk about the gift card liability, right? And then revenue recognized from gift card liability balance at the beginning of the year. And then if we go to Chipotle Rewards, which is also a nice breakdown of it, they give information on that with the revenue deferred and the revenue recognized. So just so people understand the revenue deferred and recognized thing, deferred revenue is basically money that you're collecting, but you're not accounting for it as if you've actually earned the money, whereas the revenue being recognized later isn't helpful in the sense of cash, that you're, at that point it's not useful. So if people are focused on earnings per share, something investors, then they might be care about when the revenue is recognized. However, more of people like us, people who are more focused on the cash flow and stuff, are going to care more about deferred revenue as a source of float. So then they talk about the fair value of the financial instruments. So they talk about their investments consist of U.S. maturities, U.S. treasuries with maturities of up to 1 year. So it's cash. So I'll just count it as cash. This is interesting. They have restaurant closure costs, right? And things like that. So, let's see if we can find any more lease details. So if you want to scroll down, or if you could see anything that gives more information about leases, that's the one thing that we really want to find, details on.
There's going to be so many of these. I'm surprised that they didn't have, like, some sort of...
Yeah. So often companies will have a lot of detail here. Here's the contractual obligations. Yeah. So their operating leases are what matters. They also have large purchase obligations. It's interesting to note. So those are very, very large purchase obligations for a company, which probably means that they're using a small number of vendors and guaranteeing that they'll buy a certain portion of stuff. Places like McDonald's and stuff will do that too. So if you notice, their purchase obligations mean that in 2020, they're promising to buy like $600 million worth of stuff.
Yeah.
And then they're even promising to buy some out into 2021, 2022. So that's
kind of like points, right?
Yeah. So it has to do with, like, economies of scale and stuff like that, probably, by promising to buy that much, because they're got to be one of the biggest buyers of all those sorts of things. So anyway, the operating leases, we can see the payments due and see that a ton of it is the thereafter period. So 2.5 billion.
Yep, 2.5 billion
is after 2024.
Yeah, so that's longer term
than 5 years.
For sure. Yeah.
So you can get that information even though they didn't tell us. They just said, like, that it's 1 to 20 years or something. You can tell that. So we could just do the math quickly there. So 2.5 And then we divide that by the total amount, which is how much? 4.1?
4.1.
Okay. Then we have 61% of it is due and after 5 years, right?
Yeah. Mm-hmm.
And so you only have about 39% due in shorter than 5 years. So one thing we could do is we could just take 5 and divide by 0.39.
Oops. 5 divided by 0.39.
Which is what I was saying before. If you remember before, I said, like, do they really have about an average of 13 years? Again, we're getting a number that says it's an average of about 13 years. So that may mean that they keep opening places because they said our initial terms are 1 to 20 years.
Yeah.
And they don't count usually the option. Now, they said that they might count the option cases where it's reasonably certain that they'll exercise the option, which I assume means it has to be closer to the date that they would use it. But what that means is they are basically borrowing the location. That's what you're doing when you're renting a place for assigning a lease to it for 13 years on average left on it, so that's a major obligation. So, as we said with the balance sheet, the things that I would care about with Chipotle, right, are their huge amount of cash and their investments. And then I compare that to the obligations that they have in the term of these leases, which were off balance sheet stuff before and are now on balance sheet. And so people have to kind of decide how they think it should be, how you should value things. So, like, for instance, I guess the big question people would have with something like Chipotle, right, is are they earning like 10 to 20% or whatever returns?
Or is it 30%?
Like, 30, 40.
And what would you say that is?
I think for shareholders, the reality is they're earning the bigger number, but they're doing it in a way that means that if the chain is not successful and so at some point, there's not going to be any residual value and all this stuff because they have these leases. It's the thing of where we talk about like GameStop or something, but GameStop has all these leases that can quickly get out of them. Chipotle doesn't.
It's longer. Yeah.
So they need these locations. So it's obviously very location based that way. So as long as it's successful that way, you as the shareholder aren't financing it. Who's financing it? The landlord. So the landlord, the success of the Chipotle model is the landlord is really providing most of the capital in the form of that place that they're renting out to them. And then you as the shareholder are benefiting from that. From the landlord's financing, but it's all about the landlord putting up the space at a price that allows Chipotle to make all this money. And like we saw, they're covering their rent almost 3 times, right? So they can have a pretty big
very
decline
solid,
in their operating income, But companies do have operating income decline 60 or 70% sometimes.
Yeah.
And if that happened, then they wouldn't be covering their rent.
So Chipotle start to innovate a little bit. Make me a breakfast burrito.
Okay.
Make me a breakfast burrito. Well, I want to thank everybody so much for tuning in with Geoff and myself on going over the balance sheet in today's podcast. If this is the first time you're tuning in, rating and review really goes a long way for us. A comment on whether it's on YouTube or on the podcast app in general, it just really goes a long way for us. I want to thank everybody so much for tuning in with us here today. Check out all of our content. Go to focuscompounding.com. If you sign up for Geoff's stock research, use the podcast promo code, which is podcast, and follow me on Twitter at Focused Compound. Hit that subscribe button, follow along for future videos, and we will see you in the next podcast. Hey, this is Andrew Kuhn, and that was the Focused Compounding Podcast, the podcast where Geoff and I talk about actionable stock ideas, investing concepts, and the overall way that we think about investing at Focused Compounding Capital Management. Go to focuscompounding.com and enter in your email to get a free watch list from Geoff every other week. And be sure to check out all of our other work where Geoff writes about stocks at focuscompounding.com. I upload how-to investing videos on YouTube, and we both manage capital for investors at Focused Compounding Capital Management. Thanks for listening, and be sure to subscribe to follow along.